So we've talked about the first thing drilling companies need to know, which is their cost structure. Once the books are organized, where do you go next?
Then you move into how your financial statements are structured. This is your balance sheet and your profit and loss statement, also known as your income statement, right? And a really important concept to look at here is on the income statement, knowing the difference between above the line and below the line costs.
Okay, so break that down for us.
Sure. So above the line is your core operation. That is your drilling activities. Those are the things that make you revenue and the associated cost that it takes to make that revenue, right? So above the line are direct revenue and direct expenses. And above the line cost is what gets you to your gross profit. Your gross profit is telling you, am I making money on the jobs that I'm completing? That is the work that you're doing out there, right? Top line is a very important number to look at, right? Because am I quoting properly, right? Am I using manpower properly? Is the business running efficiently? Above the line tells you those key things because it only looks at two things and they're directly related to your activities in the drilling business. It's your drilling revenue and all associated revenue accounts that you have and revenue producing activities that you have, followed with your direct cost for completing that work. At the end of the day, that produces your gross profit. Profitable companies see a strong gross profit number there, and that tells them that the activities that they're doing are fruitful for their organization.
So let's talk about below the line.
Yeah, so below the line includes things like rent, your general and administrative expenses, and overhead, right? The costs that it takes to run your business, right? These aren't direct costs that are out there performing work and helping you achieve a revenue target. These are the costs that it takes to just manage and run a business, right? So at the end of the day, when you take your gross profit and you subtract your below the line costs for general and administrative costs, marketing, depreciation, things of that nature, right? You come to your net income. If your net income is positive, that tells you that you're doing a few things. You're quoting jobs properly, you're utilizing time and the resources that you have effectively to produce a profit on that job. It also tells you that you're managing your overhead properly, and the overhead is in line with your revenue producing activities, meaning you don't have too many people on staff for the number of jobs that are taking place. Your insurance is in line with business activities and how much revenue your company is generating. There's not all sorts of extra cost or what we can say fat on the books that's eroding your profit, right? That's what that tells you. If that's the case and there are those pieces that are eroding your profit, having a strong chart of accounts and P&L, income statement, line by line, it'll tell you where the numbers are off and where you really need to dig in. It allows you to spot trends. A trend analysis in your income statement is huge. It tells you, are you on track or off track? And if you spent too much, it allows you to pinpoint where that is coming from and address it.
How often should you be looking at your statements?
That's a good question. It really all depends. I'd say at a minimum monthly. It should take you a couple days, maybe a week to roll up all your books, reconcile your bank account, and once that's done, produce a set of financial statements, make some journal entries that's needed for any accruals. But after that, a sit down should take place with management and ownership to look at that and say, are we producing what we expected? We just completed a big job. How did the numbers shake out? If the numbers don't shake out according to what you had in mind, well, something happened. And that's where you have to go back and say, all right, let's go through the profit and loss statement line by line and figure this out. So at a minimum monthly, if you wait longer than that, it could be too late.
Sure.
It's not going to allow you to pinpoint and get in front of things that are coming up that you're not sure of and you didn't even know were happening, right?
Right, so from a trend standpoint, you want to look at maybe month over month, quarter over quarter, year over year.
Absolutely. Yeah, you definitely want to look at month over month. Then you want to look at the quarter. And sometimes looking at the quarter for this year compared to how you did last year, that's going to tell you, are you on track or off track with gross profit margins? Or is your spending getting a little out of control? So doing a year-over-year comparison, this month versus the same month last year, this quarter versus the same quarter last year, and then year over year, 12 months, end of this year, end of last year. That's going to tell you, you'll be able to spot necessary trends, and it all comes down to being able to make decisions. That's what this is all about. It's having the insight and transparency in your chart of accounts and financial statements to say, something is off here. We need to drill into the numbers that are going into this account specifically, break it down, and figure out what we need to do. Maybe something's not getting posted in the right account. Maybe a direct expense related to drilling is getting posted in a below the line general and administrative cost, right? So that's going to change your margins. That's going to change the optics of how margins should see, or how they should look at least, right? So having the transparency on your financial statements, looking at them regularly, sitting down with people that can make decisions using that information from them is paramount to really understanding your cost of drilling and creating a profitable business. We have a template of a balance sheet and income statement similar to the one that's on the screen at rigsource.com under the Resources tab. Let's look at the balance sheet quick. It's broken down and it's grouped by your assets, your liability, and your ownership equity and retained earnings. I've provided recommended groupings using the accounts that are shown in the chart of accounts, right? So you can reference back to those, but you'll see that they all correlate. So in the balance sheet on the assets section, you'll see the 1,000 accounts for assets. You'll see a subcategory for current assets versus total assets. This is good practice for your balance sheet. Keep following down, you'll see liabilities. These are your 2,000 accounts that we already talked about. And you have recommended groupings in there of how to classify those in your balance sheet under the liabilities section. Ownership equity, not many accounts there, but you can see the recommended groupings that are there. Next is your profit and loss statement. Starting with revenue, you can see some recommended groupings using the accounts that we've previously looked at that are included in the chart of accounts template listed for revenue and how those could be grouped if they make sense for your business. Next is your cost of goods sold. Once again, you'll see some groupings. These chart of accounts will start to make sense when you look back at your chart of accounts that we've previously talked about, right? But there's your revenue and your cost of goods sold above the line. You'll see a very thick line there that kind of distinguishes below the line cost and above the line cost. That solid dark line distinguishes that. Moving to below the line cost, general and administrative cost, right? These are all the costs that it takes to run the business per se. All these accounts are listed. You can refer back to the chart of accounts that we've talked about previously, and you can see recommended groupings that make sense that we've used historically to help us manage our business. The other expenses, depreciation, interest, amortization, if it applies to you, those are listed as well, coming down to your net income. This is a good template for you to look at. Take a look. How does it compare to your existing template and what you're currently using? If it makes sense to make a couple changes, move some groupings around to give you more insight into your business that you can make decisions on, by all means, make some adjustments. It's a good business practice to just make some subtle tweaks to see if that'll help make decisions for your business. All of these templates, this template in particular, and others that we've talked about, they're available at rigsource.com under the Resources tab. Feel free to check those out. Grab anyone that you think would be helpful to your business.